Welcome to episode 20 of the SaaS Report. I'm your host, Matt Aird, and today we've got a special episode because the Q1 State of SaaS metrics report is now live. So in that report, I've broken down 35 public SaaS companies across 15 core SaaS metrics. And what we're going to do today is dig into some of the key takeaways from that report. So I hope you enjoy this one. Let's get into it. So the first thing that's jumped out at me, and this won't come as a surprise to anyone that kind of follows the work that we do closely, but that's that go-to-market efficiency is completely falling off a cliff. And the way that we can see this is by looking closely at CAC Payback rates and the magic number metric that these companies are producing. So let's start with CAC Payback. Right, so this isn't pretty to say the least, right? CAC paybacks for these companies have blown out to 38 months as the median. That's up from 30 months in Q1 of 23 and 32 months in Q1 of 24. That's a 27% increase over the last 2 years and a 19% increase over just the last 12 months. And when we break this metric down and look at it on an individual company basis, there've been some really big swings here. SentinelOne has gone from 31 months up to 45 months in the last 12 months. CrowdStrike has gone from 20 to 33. Procore's gone from 32 months to 51 months. And HubSpot from 33 up to 45, right? It's just much more expensive for all of these companies to generate ARR growth right now. On the right-hand side of this chart, you'll see some massive blowouts. Zoom's at 164 months, Box is at 126, Asana's at 94, PagerDuty's at 84, DocuSign's up there at 78 months, right? These are insane numbers. And keep in mind that these aren't kind of one quarter fluctuations either. This is CAC payback over the last 12 months, right? So what we do is we basically take the sales and marketing spend over the last 12 months and divide that by kind of the net new ARR generated, adjusted for gross margin, right? There are some signs of life here though. Palantir, who is kind of buoyed by this geopolitical tension and this AI wave that we're in the middle of at the moment, they're producing ARR at a really strong, 13-month CAC payback. Viva, they have just freakishly low sales and marketing spend. I think that comes in at only about 15% of revenue. And so that means that they're able to get a really low CAC payback metric. That came in at 13 months in Q1 as well. Atlassian's still performing pretty well. So they've had kind of their first slide outside of this 12-month CAC payback period. So they were sitting under 12 months for the last few quarters. That's blown out a little bit to 18 months, but still pretty strong comparatively, right? But half the companies that we track right now have CAC payback in excess of 44 months, right? Which is much higher than any of these companies would like to see. We see a very similar thing when we look at magic number. So as a refresher, magic number tells us basically how much net new ARR a company generates for every $1 that they spend on sales and marketing. And again, this is a trailing 12-month metric, right? So we're removing any kind of like one quarter fluctuations here. So in Q1 of 23, this metric came in at 0.52, basically 52 cents in net new ARR for every dollar spent on sales and marketing. That dropped to 48 cents in Q1 of 24 and is now down to 37 cents in Q1 of this year. So that's down 29% over the last 2 years and 23% over just the last 12 months. So the dollars, right, that these CEOs, CFOs, CROs are deploying into their sales and marketing budgets just aren't generating the same amount of net new ARR that they did in the past. And this is in an environment where everyone is practicing kind of fiscal responsibility, right? So the idea here being that maybe we've trimmed back some of the underperforming sales and marketing spend in order to create some more efficiency in the business, but we haven't seen that pull through in terms of go-to-market efficiency, right? Those rates continue to decline over the last 2 years. Looking at this on a company by company basis, again, it's pretty ugly. Zoom, Box, and Asana all deliver less than 15 cents in net new ARR for every dollar spent on sales and marketing. Even some of the historically kind of super efficient go-to-market orgs, right? I'm thinking companies like HubSpot, Monday, MongoDB, CrowdStrike, right? They're at less than 50 cents for every dollar spent. So this is kind of undeniable proof that go-to-market efficiency just continues to decline, right? Year after year for the last couple of years now. this metric's really been under pressure. If ever we need an AI efficiency unlock, right, it's now. Right, so that's the efficiency side of things. Let's now transition and have a look at how this is impacting top-line growth rates for these companies. So what we're looking at here is median ARR growth rates for the 35 companies that we track, right? In Q1 of 23, that number was 27%. 12 months later, it had dropped to 24%, and in Q1 of this year, we're down to just 18% ARR growth as the median. So that's a 33% ARR decline over the last 2 years, and a staggering 25% decline on this metric over the last 12 months, right? This is significant. These SaaS companies trade at high multiples of revenue because of the promise of high rates of growth. If this continues to decline, they're not going to be trading at high revenue multiples, right? They're going to be re-rated and looked at like other companies and trade on a multiple of free cash flow or a multiple of net income. And so if we look at this on an individual company basis, first thing that jumps out at me here is that only 6 of the 35 companies that we track are growing faster than 30% right now, right? This is staggering. To put this in context, if you rewind to Q2 of 22, the median ARR growth rate was 45%. There are now only 2 companies growing faster than that rate, and that's Rubrik and Pegasystems. More than a third of the companies on our list are growing at less than 15% year over year. Some of the big declines we've seen in growth rates over the past 12 months, Procore dropped from 26% to 15%, CrowdStrike from 33 to 20, SentinelOne from 35 down to 23, and there are a handful of companies growing at less than 10% year over year. That's Asana, DocuSign, PagerDuty, Box, and Zoom. And you've even got ZoomInfo in negative growth, right? So their ARR shrank about 1.3% year over year. So pretty bleak picture overall, right? Now, the key theme over the last couple of years, if we've talked about, has been this concept of kind of fiscally responsible growth, right? Growth at all costs is out the window. Fiscally responsible growth is the new meta. And so how has spending on sales and marketing changed over the last couple of years? Well, there's certainly been a reduction here, and we can see that when we look at the median spend on sales and marketing as a percentage of revenue. So in Q1 of 23, that was 46% of revenue spent on sales and marketing. 12 months later, that was at 44%. And in Q1 of this year, we're sitting at 40%. So that's a 13% decline over the last 2 years and a 9% drop over the last 12 months. So without a doubt, right, these companies are reining in sales and marketing spending. The issue for them, though, is that growth rates are declining at a faster rate. So when we pull growth rate and sales and marketing spend percentage together on the same chart, we can start to see a bit of a divergence here. So between Q1 of 23 and Q1 of 24, we saw about a 4% decline in sales and marketing spend as a percentage of revenue. But during that same time period, growth rates decreased by 11%. And then between 24 and 25 Q1, sales and marketing spend was reduced by 9%, but we saw a 25% reduction in growth rates. So my first thought here is that these companies are kind of in a bit of a death spiral, right? You've got a situation where you're spending less on sales and marketing because you're not growing as quickly, but because you're reducing spend here, your growth rate is dropping even more, right? And so what I wanted to look at was, okay, well, there are still some companies growing quickly. Are they doing something different, right? Are they bucking the trend here and going, no, let's keep our foot down on customer acquisition. Let's continue to spend heavily on sales and marketing to see if we can maintain higher rates of growth, right? But when I pulled the data, right, it didn't tell me anything. The high growth companies are spending the same amount on sales and marketing as the low growth companies, right? And they're both spending actually at a lower rate than the median of the entire group, right? So there's no simple answer here, right? It's not just let's just throw more money at this and let's see if we can kind of spend our way out of this growth decline. So there's a really tough puzzle sitting in front of these companies at the moment. They're in a position where they have to re-accelerate growth rates, and it doesn't look like just throwing more money at the problem is going to fix it. The bright spot, though, for them is that they've got some leeway here, right? And that's in the form of pretty high rates of free cash flow for the companies, and that's been increasing over the last couple of years. So median free cash flow margin for the 35 companies that we track came in at 27% in Q1 of this year. That's up 17% over the last 2 years, right? So they've got the runway, they've got cash coming in, they've got time to try to figure out how to solve this problem. And that's the puzzle that I'm guessing every CEO, CFO, CRO is trying to solve right now. This is going to be absolutely fascinating to watch over the next couple of quarters. All right, thanks for tuning in this week. That's it for today. As a reminder, the Q1 State of SaaS metrics report is now live. There's a sneak peek I've just given you. In the report, there are, I think, about 46 or 47 different charts that show the state of SaaS performance as it currently sits. I'm going to do another breakdown on the report next week, showing another set of data to try to paint more of a picture of kind of what's happening in the landscape today. But if you want to go and grab a copy of that report, the link to that is in the show notes. One request from me is if you go and grab a copy of that, please stop by the YouTube page, hit subscribe. It'd mean a lot to me. We're really trying to grow our presence on that platform, and you subscribing kind of really helps us out there. All right, so thanks for tuning in. I'll see you again next week. Until then, goodbye.